Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia. Today, we're going to explore a topic that becomes incredibly important whenever financial markets experience turbulence, uncertainty, or outright panic. We're discussing why asset correlations break down, and more importantly, the macro explanation for diversification failures. Now, if you've spent any time studying investing, you've almost certainly heard the phrase that diversification is the only free lunch in finance. Financial advisors recommend it. Portfolio managers promote it. Investment textbooks teach it. The principle seems straightforward. By holding a variety of investments that don't move together, investors should be able to reduce risk while still generating returns over time. But here's the reality. Every major market crisis seems to expose a weakness in that theory. Investors often discover that assets they believed were diversified suddenly begin moving in the same direction. Stocks fall, bonds fall, commodities fall, alternative investments decline, emerging markets struggle, credit markets weaken, and the question many investors ask during these periods is simple. What happened to diversification? The answer lies in understanding asset correlation breakdown and the powerful macroeconomic forces that drive financial markets during periods of stress. Let's begin by discussing what correlation actually means. Asset correlation measures the relationship between the movements of two investments. If two assets move perfectly together, they have a positive correlation of 1. If they move completely independently, the correlation is 0. If they move in opposite directions, the correlation is -1. The foundation of diversification relies on combining assets with low or negative correlations. For example, investors have historically viewed stocks and government bonds as useful portfolio complements. Gold has often been considered a hedge against uncertainty. International markets have been viewed as a way to diversify geographic exposure. Commodities have frequently been used as protection against inflation. Under normal market conditions, these relationships can provide meaningful diversification benefits. The problem is that correlations are not permanent. Many investors make the mistake of assuming that historical correlations will remain stable forever. In reality, correlations are dynamic. They change over time. They respond to shifts in the economy, monetary policy, liquidity conditions, and investor psychology. And that's exactly where diversification problems begin. One of the most important reasons asset correlations break down is that markets eventually stop focusing on individual asset characteristics and start focusing on broader macroeconomic risks. Under normal conditions, stocks may respond to earnings reports, bonds may react to interest rate expectations, commodities may move based on supply and demand dynamics, and currencies may respond to economic growth differentials. But during periods of stress, all of those individual drivers become less important. Instead, investors begin focusing on a small number of dominant macro factors that affect nearly every market simultaneously. As a result, assets that once appeared independent begin moving together. This is one of the clearest macro explanations for diversification failures. Let's talk about liquidity because liquidity is often the hidden force behind correlation breakdowns. During calm market conditions, liquidity is abundant. Investors can buy and sell assets relatively easily. Markets function normally. Price discovery works efficiently. But during crises, liquidity can disappear surprisingly quickly. When investors face margin calls, redemption requests, funding pressures, or losses elsewhere in their portfolios, they often need cash immediately. At that point, the question changes. They're no longer asking, what do I want to sell? They're asking, what can I sell? That's a very important distinction. Investors may begin liquidating profitable positions simply because those assets remain liquid. High-quality investments get sold alongside weaker investments. Fundamentals become secondary. The primary objective becomes raising cash. When this behavior spreads across the financial system, correlations rise sharply. A classic example occurred during the global financial crisis of 2008. During that period, investors sold equities, commodities, corporate bonds, emerging market assets, and many alternative investments simultaneously. Assets that previously exhibited relatively low correlations suddenly began moving together because liquidity concerns dominated investment decisions. In other words, liquidity became more important than valuation. Now, let's move on to another major factor behind asset correlation breakdowns, and that's central bank policy. Modern financial markets are heavily influenced by central banks. Interest rates, monetary policy, quantitative easing, quantitative tightening, and overall liquidity conditions affect virtually every asset class. Following the 2008 financial crisis, many central banks adopted extremely accommodative monetary policies. Interest rates remained near historic lows for years. Liquidity was abundant. Investors were encouraged to seek higher returns in risk assets. This environment supported equities, corporate bonds, real estate, technology stocks, and numerous alternative investments. In many ways, markets became driven by liquidity. However, when inflation surged and central banks began aggressively tightening policy, the environment changed dramatically. The year 2022 provided a particularly important lesson. Many investors expected bonds to offset stock market losses. Historically, that relationship had often worked. But rising inflation and higher interest rates negatively impacted both stocks and bonds at the same time. Many diversified portfolios experienced losses across multiple asset classes simultaneously. This highlighted a critical reality. Correlations are heavily influenced by the prevailing macroeconomic regime. When inflation becomes the dominant concern, traditional relationships can change quickly. When economic growth becomes the dominant concern, correlations may shift again. And when liquidity becomes the dominant concern, correlations often rise sharply across nearly all risk assets. Let's also discuss the concept of risk-on and risk-off environments because these play a major role in diversification failures. Financial markets tend to cycle between periods of optimism and periods of caution. During risk-on environments, investors seek growth opportunities. They allocate capital toward equities, emerging markets, growth sectors, speculative assets, and higher yield investments. During risk-off environments, investors become defensive. Capital preservation becomes the priority. Demand for safe haven assets increases. The challenge is that transitions between these environments can occur rapidly. As fear increases, investors begin making similar decisions simultaneously. Instead of evaluating each asset individually, they broadly categorize investments as either risky or safe. This herd behavior causes correlations to rise. Assets that previously moved independently begin responding to the same emotional and macroeconomic drivers. The result is another example of why asset correlations break down during market crises. Now let's talk about globalization. Financial markets today are far more interconnected than they were several decades ago. Capital flows across borders instantly. Institutional investors manage globally diversified portfolios. Supply chains stretch across continents. Information travels worldwide in seconds. These developments have created tremendous economic efficiencies, but they've also increased systemic interconnectedness. Consider what happens when a major economic shock occurs. A slowdown in one region affects international trade. Reduced trade impacts corporate earnings. Commodity demand changes. Currency markets react. Bond yields adjust. Equity valuations shift. The effects spread rapidly across the global financial system. As markets become increasingly connected, diversification across countries alone may provide less protection than investors expect. Globalization has increased the probability that multiple markets respond to the same macroeconomic events simultaneously. Another major contributor to asset correlation breakdown is leverage. Leverage can enhance returns during favorable conditions, but leverage can also amplify losses. Many hedge funds, institutions, and professional investors borrow capital to increase exposure. When volatility rises and asset prices begin falling, leverage participants often face pressure to reduce positions. This creates a feedback loop. Prices fall. Margin requirements increase. Investors sell assets. Correlations rise. Volatility increases further. Additional selling occurs. The cycle feeds on itself. One famous example was the collapse of long-term capital management in 1998. The firm's positions appeared diversified based on historical relationships. However, when markets experienced stress, many of those relationships changed simultaneously. Assets that were expected to remain independent suddenly became highly correlated. The lesson remains relevant today. Diversification assumptions can fail precisely when leverage and liquidity pressures become dominant forces. We also cannot ignore the role of investor psychology. Markets are driven by people, and people are emotional. Behavioral finance has repeatedly demonstrated that investors do not always behave rationally. Herd mentality encourages investors to follow the crowd. Loss aversion causes individuals to react more strongly to losses than gains. Recency bias leads investors to assume current trends will continue indefinitely. These psychological tendencies become particularly powerful during market stress. Fear spreads quickly, selling accelerates, correlations rise, and diversification benefits decline. This is why understanding human behavior is just as important as understanding economics. Let's briefly look at several historical examples. The 2008 global financial crisis demonstrated how liquidity concerns can drive widespread correlation breakdowns. The COVID-19 market panic of 2020 showed how uncertainty can trigger simultaneous selling across multiple asset classes. And the inflation shock of 2022 revealed how rising interest rates can challenge even the traditional stock bond diversification model. Each episode reinforced the same lesson. Correlations are not fixed. They evolve based on economic conditions, liquidity, policy decisions, leverage, and investor behavior. So, what can investors do? First, investors should focus on economic regimes rather than relying solely on historical correlations. Second, portfolios should be stress tested against different scenarios. Third, liquidity conditions should be monitored closely. Fourth, investors should pay close attention to central bank policy and macroeconomic developments. And finally, diversification should extend beyond asset classes and focus on underlying risk factors such as inflation risk, growth risk, interest rate risk, and geopolitical risk. Before we wrap up today's episode, I'd also encourage listeners who want access to a world-class, cutting-edge, user-friendly trading platform app to visit crystalbellmarkets.com/platform. The platform provides powerful tools and resources designed to help traders and investors navigate today's increasingly complex financial markets. And if you're interested in learning more about trading, investing, macroeconomics, and financial markets, be sure to check out the Crystal Ball Markets podcast at rss.com/podcast/Crystal Ball Markets. It's packed with beginner-friendly insights and educational content that can help investors better understand the forces shaping global markets. To conclude, asset correlation breakdowns occur when powerful macroeconomic forces overwhelm traditional diversification relationships. Liquidity crises, central bank actions, leverage, globalization, risk-on and risk-off shifts, and investor psychology all contribute to rising correlations during periods of stress. Diversification remains a valuable risk management tool, but it is not a guarantee against losses. The most successful investors recognize that market relationships are dynamic, economic regimes evolve, and effective risk management requires constant adaptation. Thank you for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you again in the next episode.